Okay, so thank you for joining us today. I would like to welcome back Shawn Bausch of Advisors. Shawn is a Canadian CPA as well as a US CPA. He is a native from the GTA and has spent 11 years working and studying in the US. Shawn is the founder and principal at SB Advisors. He has a particular interest in planning for business owners, assisting them with their business matters and their family trust and retirement structures. In addition to Canadian tax services, Shawn delivers U.S. services from SB Advisors offices. Through his network, provides international tax support to more than a dozen countries. Shawn is also extremely active in nonprofit boards and governing bodies. Welcome back, Shawn. And Peter Gottschlich is joining us from Mills and Mills. And Peter joined Mills and Mills in 2021 and practices within the business law group. Prior to joining that firm, Peter served for over a decade as a senior in-house counsel to one of Canada's major accounting firms. Peter has expertise in all corporate, commercial, and partnership governance matters, including contract negotiations, drafting, review and management, transactional work, commercial leasing, employment law, and regulatory compliance matters. Peter is a member of both the Law Societies of Ontario and British Columbia, and has completed a Master's of Business Administration from Edinburgh Business School and attained a Bachelor of Law and an Honours Bachelor of Arts in History from the University of Saskatchewan. Peter strives to provide clients with practical legal advice to ensure they make tactical decisions in all strategic business matters. So without further ado, I'm going to hand the screen over to Peter to please take it away.
Thanks very much, Lori, and thank you everyone for joining us today. I'm going to be discussing first just about the legal aspects of buying and selling a business, and then I'll pass the baton over to Shawn, and he'll discuss the accounting and tax components of that. So I'll try to share my screen here. No, not that one. Just a second. Perfect. So now hopefully you can see my full screen of the legal aspects of selling a business. Lori, is that what you see on your screen?
Yes, we do. Thank you.
Okay, perfect. So as Lori mentioned, I'm from Mills and Mills, and I help all types of business owners and potential business owners buy and sell their business. Today, what we're going to talk about, before we talk about buying and selling businesses, I think it's important to just briefly discuss how a business can be owned and the ownership structure of a business. Once we understand that, the difference between how businesses can be sold, generally they would be sold through a share sale or an asset sale. After that, we're going to discuss about getting a business ready to sell and what components might you want to consider before putting a business up for sale. Again, the next point we'll talk about performing proper due diligence in both buying a business and also marketing a business to potential buyers. We're going to discuss acquiring a business, and then I'm happy to answer any questions at the end. So before we jump into talking about selling a business, we've got to understand how a business can be owned. Essentially, there are three different ways that a business can be structured: a sole proprietor, as a corporation, or through a partnership. Now, a sole proprietor is the simplest form. It's a single individual that owns and operates the business. So, for example, Peter Gottschlich, I could have Peter's Woodworking. I could go and register a business name, Peter's Woodworking, and I'm in business. The characteristics of that And the benefits of it is that it's simple. It's easy and expensive to set up and operate. The liability of that business is personally on me for all business debts and obligations. I report my income tax of the business on my own personal tax return. And as a sole proprietor, I have complete control over the business decisions. The next way to operate a business, and most common, would be through a corporation. So a corporation is a legal entity that is separate from its owners, that are known as the shareholders, that can own property, enter into contracts, and be liable for its own debts. So taking our previous example where there was Peter's Woodworking, I can go and incorporate a company, let's call it ABC Woodworking Inc., and I become the owner or the shareholder of ABC Woodworking Inc. As a shareholder or as the owner of ABC Woodworking Inc., I can decide on all matters of that corporation. I can appoint directors. I can appoint officers who are like the employees of the corporation to operate the business. Now, the characteristics of a corporation is that shareholders have limited liability. Their personal assets are generally protected from business debts. So in our example, if ABC Woodworking Inc. is doing the work for clients, clients have a direct relationship with ABC Woodworking Inc., but they don't have one with me, Peter, as the individual. A corporation, the taxes are subject to corporate tax rates, and there's a potential for different tax treatments and deductions through a corporation. Now, a corporation is more complex than a sole proprietorship, and there are some costs to maintain it, and it requires some compliance with corporate regulations, but generally the benefit of having a corporation is well worth the effort. Corporation that is managed by a board of directors and executives, and the shareholders elect the board to run the corporation. The third way to own a business is through a partnership. Now, this is less common than most businesses because generally partnerships are reserved for people like accountants, lawyers, architects that would run their business through a partnership. Now, a partnership is a business owned by two or more individuals who share the profits, losses, and management responsibilities. Now, in a partnership, there are generally two types. A general partnership, where all partners are involved in managing the business and are personally liable for its debts. The other way is a limited partnership, oftentimes with accounting firms, with law firms. You'll see LLP, which means limited liability partnership. And this includes having a general partner with unlimited liability, generally a corporation, and then limited partners with limited liability for their investments. Now, in a partnership, the decisions are typically made jointly amongst the partners with varying levels of control depending on the partnership agreement that governs the partnership. So now that we know what the three structures of holding a business are, I'd like us to discuss what are the ways that a business can be sold. Generally, there are two types of ways to sell a business. You can, and for one of the examples that I'm using, I'm going to assume that the business is owned by a corporation. So the two different ways to sell a business are you can sell the shares or you can sell the assets of the business. So in a share sale, there's the sale of the ownership interest in the company. So going back to our original example, I own shares in ABC Woodworking Inc. I can sell to any third party my shares in ABC Inc. And if they're the only shareholder of ABC Inc., they control everything that ABC Inc. owns and controls. So the implications of a share sale is that the buyer acquires the entire company, including all assets and liabilities. There's a continuity of business operations and contracts, and there's a potential for easier transfer of permits, licenses, and contracts.
Peter,
And generally, it's the yes.
Peter, sorry to interrupt. I'm still seeing the very first slide. Have more slides gone through?
Yeah. Oh, sorry. I am. Yes. Thank you, Lori. I appreciate that. Just as I don't. Just a second.
Okay, thank you.
No, thank you for yeah, I've I will share my presentation at the end of this presentation with Lori so everyone can have this. Just a second.
We see agenda now.
Uh, just a second. Sorry.
No worries.
I'm going to just share a screen. I know that's not the best. Okay. Now, if I scroll through this, do you see ways to own a business?
Yes, we do.
Okay, perfect. Sorry. Okay. So I think this is where we were. Difference between share sales and asset sales. In a share sale, it's this sale of the ownership interest in the company, and the buyers would acquire the entire company, including all assets and liabilities of that company. There's a continuity of business operations and contracts. ABC Woodworking Inc. continues to do business with all of the people that it does business with. Which allows for a easier transfer of permits, license, contracts, and generally is the preferred for businesses with significant ongoing operations and valuable contracts. An asset sale, by contrast, is a sale of specific assets and liabilities that you would be transferring, and it's not the entire company. Now, an asset sale, an individual, a sole proprietor can sell assets, but a corporation can also sell assets too, if it wants to keep some of those assets for itself in the corporation. Now, the implications of an asset sale, or buyers select specific assets and assume certain liabilities. And the advantage of this structure is that there's the potential for avoiding hidden liabilities. It requires the transfer of individual contracts, permits, and licenses, and it often used when the business is being sold piecemeal or when the buyer is not interested in inheriting all liabilities. So the analogy I like to use between the difference between a share sale and an asset sale is think of a bowl of fruit. If I sell you the bowl and all of the fruit that is in that bowl, that would be analogous to a share sale. You get title to the bowl, and everything in that bowl is yours. By contrast, an asset sale, I present a bowl to you and say, there's some fruit in here. Choose 3 pieces of fruit, or which fruit would you like to buy? Then you can go in and inspect the fruit that's in the bowl. Ones that are, say, beyond, they're rotten or they're not great fruit, you can say, I don't want those, and you can pick and choose what you want out of that bowl. That's the same as an asset sale. So now that we understand the 2 different ways of selling a business, what are some things that a seller would want to consider before selling a business. So let's talk about getting a business ready to sell. First one would be the financial preparation. Does it have clean financial records? Ensure that there's accurate, up-to-date financial statements. Make sure that from a corporate perspective, officers, directors are appointed, that annual returns have been done, that the corporation is essentially up to date. You may also wish to get a valuation on the business to determine the business's worth. There are business valuators out there that might be able to assist you as a business owner to put a price tag on what a business might be worth. From the legal perspective, is the corporation current? Ensure that the corporation is up to date and is in a position to sell assets or shares. This seems like an obvious thing, but oftentimes corporations are incorporated, their minute book is put on a shelf, and people forget about actually keeping it updated and current. So then we realize that the shares of a corporation, those people are no longer even involved in the corporation. The directors have died or retired and don't have the ability to transfer over the shares or the assets over to the new buyer. So it's important to make sure the corporation itself is up to date. Review contracts and agreements and make sure that they are kept up to date. Examples would be a lease agreement. Maybe the business operates out of a rented commercial space. Are the lease agreements current, and can they be assigned to a potential buyer? Compliance. Ensure that compliance with all relevant laws and regulations. Is it up to date? Does the business need any licenses to operate? And a part of licenses and being current is intellectual property. The business has a name, and that business may have trademarks. Are all of those up to date, and can they be transferred? Operational preparation as well. Staff have access and address of any employee-related issues or concerns. Are the employees, do they have proper employment agreements in place? Customer contracts, are the customer contracts up to date? Are they in good standing, and can they be transferred to a buyer? And the assets, maintain and improve physical and intangible assets. So essentially, just like if you were to sell a car, you'd want to get that car cleaned and ready to be transferred so that if any repairs needed to be done, it's in a much more marketable state if it's clean, operable, and ready to serve the next owner. A business is no different. If it is clean and in working order and ready to be transferred over to a new owner, then it's in a much more marketable position to sell. Performing due diligence. If from a buyer's perspective, they may want to do financial due diligence of reviewing financial statements, tax returns and cash flows, legal due diligence, operational and due diligence. So to take a review of what it is, the business that is being offered for sale and what they are selling. From the seller's perspective, to prepare all documentation of the business that's being put for sale, gather and organize all necessary documents and information, and also to address any red flags. Is the company being sued by anyone? Are there any claims from any third party that need to be resolved before the company can be transferred over to the new owners? Now, from acquiring a business, once we've gone through just the due diligence stage or the initial due diligence, because there are different levels of due diligence. If a buyer would be interested in acquiring a business and they know that the business may be a good fit for them, The next step would be negotiating the terms and conditions of the sale, including price, a payment structure, and contingencies for the transfer of the assets. An agreement would include representations and warranties to establish representations and warranties regarding the condition of the business. Generally, you would have a sale agreement, either an asset purchase agreement or a sale or a share purchase agreement that would be drafted and reviewed to include key provisions relating to the sale. It would transfer the ownership to ensure there's proper documentation and transfer of the ownership, including the assets, liabilities, and intellectual property, commercial leases, employees, for example, just to name a few of the things that would be transferred over. And then finally, once you have a either a share purchase or an asset purchase agreement finalized, the parties would need to close on the transaction. They would conduct final reviews and checks to ensure everything is in order, that the seller, that the representations and warranties are indeed correct, and that everything can be transferred as they say they're going to be transferred. And then to develop a plan to transition ownership. So that's basically from a high level of how a business can be bought and sold. I see my time is probably up, so I will maybe save questions for the end. Thanks for listening to my part of the presentation. This is just general information, and if I could help anyone, I'd be happy to help you out. Thanks. And now what I'll do is I'll stop sharing and I'll pass the torch over to Shawn, who will provide his presentation.
Well, thank you very much, Peter, for that. Okay, so moving over to the tax side of things. What we have here, okay, see, I'll share my screen. This being the third presentation in a series of 4 that we have planned about business succession planning. We're focusing here on the sale of a business, just to remind everybody of the context. And following Peter's introduction about how a sale can be completed, the legal aspects of completing a sale, we're going to look at some very specific instances of the tax considerations that are inherent with the sale of a business. Okay. Hopefully, can my screen be seen by everybody?
Yes, it can.
Yes.
Great. Okay. Still working? Okay. Okay. So a note at the outset, of course, the facts and examples here do not constitute tax advice. These are facts about tax law, and the examples are for our discussion purposes here today. Tax advice is always highly specific to your individual circumstances. So to get advice that's most relevant to your situation, you should always consult a qualified tax advisor. So this is our roadmap from our series on business succession. And we're looking at number 1 today, sale to an unrelated third party. Okay. So planning in general. Well, why bother? Sometimes things happen out of the blue, right? And you need to react to them in order to take advantage of an opportunity. But in terms of a sale, there are still things that you can do ahead of time in order to be in the best possible position to respond to those opportunities. And that's what I'm going to be focusing on here and show you the advantages of planning. In general, of course, good planning gives you more time to enjoy your personal time, your personal life, and more space to deal with these things in an orderly manner. And usually the result is a better financial result for you, or at least the optimal one possible under the circumstances. So selling your business. I'm going to focus on the differences between the asset sale or the share sale. And in my discussion, I'm going to assume that this is a business that's run through a corporation. Okay, so on the first end, which is some general aspects, we're going to look at asset sale first, and then we'll discuss the share sale and compare the two. In an asset sale is often favored by buyers as a safer option. Why is that? Because, and Peter's alluded to that, because a buyer of a business that's buying a corporation is going to assume all of the liabilities and any kind of legacy operations and legacy relationships of that corporation. So they're going to step into the shoes of the previous shareholder. Now, a lot of buyers don't necessarily want that because, as you can imagine, it's difficult, perhaps impossible, for them to know exactly to their satisfaction what's gone on in the business, to be sure about that. So buying assets is a safer option for buyers, right, where they can get the business without assuming the legacy liabilities of the corporation. However, an asset sale is more complex. You're going to require, there's more decisions to be made about the assets, the actual assets that are going to be sold, the values that are going to be ascribed to those assets, and how they're going to be transferred to the buyer in the transaction. It requires more legal work, it requires more tax work. Okay. In an asset sale, there are also potentially more taxes than there are in a share sale, more types of taxes. The best example would be if you're transferring land as part of a sale of a business, you're going to have land transfer tax. Liabilities. In an asset sale, similar to what I was highlighting about why a buyer prefers an asset sale, similarly, the seller could have liabilities remaining in the corporation which they need to satisfy. So depending upon the details of the deal, that may not be preferable to the seller, depending upon how the negotiation goes. And as a result, sellers in an asset sale typically ask for a higher price from the buyer than they would if they were selling the shares of the corporation. And then, of course, as we've spoken about, there's the legacy liability. As a seller, you are going to continue to be liable for the legacy debts of the corporation. And even if you were to wind up the corporation after selling the assets, there are certain liabilities of that corporation which continue to be liabilities of the former directors of that corporation. So they don't go away. Okay. Let's look at the financial impacts. Right? So let's take an example. Let's assume a business is, for discussion purposes, is worth $1 million, or you have an offer to buy the assets of the business. For this discussion, let's say they're the net assets of the business for $1 million. Okay, and let's say the cost base of those assets, again, just for discussion purposes, is $100 to make it easy for our future comparison. So we have a net gain of almost $1 million. Okay, how is that going to be taxed, right? So your corporation here is selling the assets of the business, so the corporation is incurring the gain. So the first level of tax is corporate taxation on capital gains. And as you may or may not know, there was a recent change to the capital gains tax rates in Canada that was made effective in June of this year. And the rate on corporate capital gains is going to be 35.69%. So you've got a tax of over $356,000 at the corporate level. Okay. So when the cash is then paid by the buyer to the corporation selling the assets to the buyer, after paying corporate income tax, the corporation is going to be left with about $643,000 available to the shareholders of you to extract from the corporation at whatever time you like. When you do extract that amount from the corporation, you're going to incur tax at the personal level, because a lot of those funds that you're going to pull out are going to be taxed as dividends. Now, they could be taxed as dividends at the high dividend rate, or the low dividend rate, depending upon the attributes of the corporation. So the two possibilities are illustrated here. To give you the example, there could be between $121,000 and $147,000 of personal tax. Okay. And this is assuming that you're in the highest tax bracket. So your net proceeds after tax are between $495,000 and $521,000. Okay. And then, of course, if you're in lower tax brackets, you can improve upon these results. But, for illustrative purposes, if you're in the highest brackets, this is what you can expect. Okay. So moving forward, a share sale. In contrast to the asset sale, as you might imagine, the share sale is a much simpler transaction from the seller's perspective. The buyer is just going to purchase the shares that the seller owns of the corporation, and there may be multiple classes and whatnot, but it's still a simpler transaction because of the nature of what's being transferred. There is continuity of the brand and the business, easier continuity. I mean, it's still possible, perhaps, in an asset sale if you're selling trademarks and whatnot. But continuity of the business and the business processes, certainly the financial processes, because they've already been set up for this corporation, right? It's registered with Canada Revenue Agency, and it's got its history there and the access and whatnot to process compliance. It's easier. And then the most significant item here to highlight are the potential tax advantages available for sellers of shares of a business. And we're going to look at some of those possibilities later on. Okay, so here we have an example of the sale of shares of the business, to contrast what we just discussed about the sale of the assets. So we take our sale price again, it's $1 million. The buyer is going to pay $1 million for the shares of your corporation. And let's assume that you started the corporation with $100. You put $100 into the business in exchange for your shares. So that means the net gain again is going to be almost a full $1 million on this sale. Okay. Assuming you own these, this assumes that you own the shares of your corporation as an individual. You're not using a holding corporation or a trust. Let's assume that you're owning these as an individual for discussion purposes. Okay, so under the new capital gains rules, you're going to be on the first $250,000 of the gain, you're going to pay tax at 26.76%. And on the gains over and above 250, you're going to pay tax at the higher rate of 35.69%. For total tax of $334,539, leaving you with net proceeds of $665,000. Now that's already tax in your hands personally. The buyer has written the check to you as an individual, right? So you don't have to pay a dividend through a corporation to get that into your personal account. That net amount is yours to use for whatever personal purposes you like. Okay? So, and again, of course, because this is all in your personal hands, you're going to be in the highest tax bracket in the year of such a sale as this, right? So these tax rates are actually more likely to be accurate, possibly slightly lower if you don't have other income on your tax return that year. All right. So this is, as you could see, a better result right off the bat. So let's look at them side by side. So in our two examples, and for discussion purposes, we've made the net gain the same so that you can see the effects of apples to apples comparison of assets versus share sales. And right away you can see, you're better off in a share sale by $170,000, $144,000 or $170,000. And that is something to keep in mind whenever if you're in a discussion, a negotiation for sale, right? As a seller, you're going to be better off after tax by a share sale than an asset sale, and therefore, if your buyer is demanding an asset sale, you're going to want to discuss the price carefully in an asset sale. Okay. So obviously, tipping the scales in favor in one direction towards a share sale. Now that discussion is a basic sale. It does not take into account any tax planning or any of the exemptions that are available for the sellers of a business. Right? And there are some significant advantages available to sellers of shares of a small business corporation in Canada. So first of all, the first one, and many of you may have heard about this, is the lifetime capital gains exemption available for a sale of qualified small business shares. So that's a defined term in the Income Tax Act. And if the shares of your corporation qualify, up to $1.25 million in gains can be exempted from tax completely. So if we go back to our example here, where we have gains of just under $1 million, in this example, if the shares of the business qualified, you would pay zero tax on the sale of those shares. The gain is under $1.25 million. Okay. Now, there are very specific criteria that must be met in order to qualify, in order for the shares to qualify for this exemption. There are 4 primary criteria, and it's a very detailed examination in order to ensure that the sales do meet the criteria as specified by the Income Tax Act. But as you can see, the potential rewards for meeting those criteria are significant. Therefore, sellers or even potential sellers often spend time in advance in order to ensure or determine whether or not the shares of their business might qualify in the future. Now, if you've got an offer on the table, you might not be able to take any steps to ensure that these shares qualify. If they qualify as is, okay. But if they do not, and you have an offer in front of you, you're likely not going to be able to take any steps to make them qualify. So when considering this option, it's important that you look ahead because one of the criteria is that the shares satisfy a condition 24 months prior to a sale or even contemplation of a sale. So it's important that you start working with tax advisors in advance of a sale or even being in touch with a buyer, getting an offer on the table to put yourself in the position to take advantage of this exemption. Okay. Now, the exemption is currently at $1.25 million, but and it will be $1.25 million again for 2025. But in 2026, that exemption will begin to be indexed again for inflation. So it's going to increase. So every individual in Canada has this lifetime exemption available to them, and whatever is unused remains available for use in a future transaction, and the amount does increase. So if you had used all of this up, or if you had used, the previous limit was just over $1 million. If you'd used $1 million exemption a couple of years ago, you would still have $250,000 left for 2025, and some of 26. And 26, it's going to be indexed again, so you'll get additional room added to that every year thereafter, according to the current legislative plans. Okay, so that's the exemption for qualified small business shares. So there's another exemption which was introduced in April of this year called the Canadian Entrepreneurs Incentive, and this is also an exemption for business owners who are selling shares of their corporations. And again, the shares of the corporations need to meet specific criteria in order to qualify for this incentive. And some of those criteria include things like the sellers have to be founding investors. So it has to be the person who started the corporation who's now selling the shares of the corporation. The seller also has to be actively engaged in the business at the time of sale, right? Actually, and for several years prior to sale. So it can't be someone who's retired now having their business, run by a third party or by family members, right? And there are a host of other requirements as well in order to qualify for this incentive. So it's not quite as generous as the small business share exemption, but it is significant. The tax rate can be reduced by 50%. So if we go back to our example again, instead of paying personal tax of $334,000 in the share sale, you'd be paying tax of $165,000. Okay. So that is also an excellent opportunity to take advantage of if you can. And the criteria are slightly different, though similar to the criteria of the qualified small business shares. So it is possible to qualify for the entrepreneur's incentive, even if you do not qualify for the qualified small business shares exemption. Okay. Okay. So some additional considerations about your sale. And these will affect the tax outcomes of your transaction. So number one, an installment sale. So there's no requirement that you receive all of the proceeds of sale and recognize all of the gains of sale immediately upon signing your sales agreement. You can structure that sale over time. Now, obviously that could result in a different cash flow situation, but it does give you the opportunity to defer the taxes up to 5 years, no longer than that. So even if your payout is more than 5 years, you can only defer the taxes related to the sale up to 5 years. So that could assist you, for example, if you're looking at that tax bill. We'll just go back to it. In either of these scenarios, you've got total tax here varying from $334,000 in the share sale up to $504,000. Well, it's the corporate tax. If you're looking at the $356,000, you could be spreading that out over 5 years instead of paying it all at once, right? So that could give you some advantages to maybe earn some investment income on the proceeds, and maybe that's a better after-tax cash result for you. Number two, vendor take-back financing, right? It's an option, just like in a real estate transaction. You can do this in a business sale, and that financing could result in additional income to you. It's true that income would be taxable, but it is more cash at the end of the day. Number three, perhaps you would like to have some sort of reward for the future performance of the business after the sale. And that is possible. You can negotiate adjustments to the sale price for milestones hit by the business. If the business continues to do well, perform up to certain levels, your sale contract can have adjustments to the sale price, upward adjustments and increased payouts to you for that performance. The tax treatment of those adjustments is going to be dependent upon the structuring of those kinds of adjustments in the contract. They could be taxed as capital gains, or they might be required to be taxed as ordinary income. But it could also, again, just be more income to you after tax on the sale of your business. So it could be an advantage. Okay. So pre-planning for sale. So to take advantage of those exemptions, as I was highlighting earlier, the shares of a business, seller of shares of the business, the shares of the business can take advantage of those exemptions. The shares have to meet certain criteria. So you want to make sure that those criteria are met ahead of time. And again, because in specific instances, for example, the QSBC shares exemption, the shares have to qualify under a certain condition for at least 24 months prior to the beginning of negotiating a sale. So it means you can't have an offer letter on the table during that time frame. So it's important to take a look at this in advance if you think it's possible that you would sell your business at some point. So an easy test is, just think about, would I, if X offer came along, would I sell this business in 2 years? If the answer is yes, it's probably worth your while taking a look at this. And this is a case where then knowing the criteria and whether or not the business qualifies, you'll also get the thresholds that are appropriate for your business, and your tax advisor can tell you that that these are the levels to watch out for. Make sure the business remains in these levels if you are thinking of selling within 2 years. So that's a significant one. Another significant advantage, which we haven't gone into in detail here, but we spoke about in the second presentation of this series, and that would be multiplying the exemptions and income splitting. So it is possible, because every individual receives or has that lifetime exemption available to them of $1.25 million. That exemption is available to all of the shareholders of a business. So if your business is structured in such a way as to involve perhaps usually it's other members of your family in the shareholding structure, typically through a trust, it's possible to multiply the number of exemptions that are applied on the sale of shares of the business. And you can see how that can become a very powerful tool. Even 4 individuals multiplied gets you $5 million of exemption. That would satisfy a great number of businesses in Canada to have that exemption. And there's no limit to the number of individuals who can own shares, whether directly or through a trust. So there is, in theory, the only limitation is your capacities to involve others in the share ownership in a way that you're comfortable with. Right? So, and again, that would need to be set up in advance. So you would want to speak with your tax advisor at least 24 months in advance of even beginning negotiations with a third party for the sale of your business. Okay. That's it. That's it for the planning aspects. And I'll list here, this will be in my slides if you'd like to refer to this later. But these are some general tax compliance requirements in the sale of a business to watch out for, that your tax advisors will be watching out for as well. Okay. I'll leave that for your reference. And I'm happy to help and answer any questions you might have. Thank you.
Don't talk.
Yeah, hi, this is Pete Gallagher from Convoy. On the are there any limits under the Canadian Entrepreneurs Incentive to the amount of money that can receive that 50% tax deduction? Is it capped at a certain amount, or?
Yeah, I mean, great question. So this is a new incentive. So I certainly haven't been through a transaction under this incentive. It's up to $2 million of capital gains for each individual seller over their lifetime. Yeah.
2 million, yeah.
Yes, yeah. So it's a higher limit than the QSBC limit. Yeah.
Right. And with two partners in a business with different families, would you still recommend? So we've got family members from both, from both families working in the business. Would you suggest then that you would still need to split the shares? Obviously, if the shares are split at 50% as it is at the moment, you would still split them 50% shares between the family members that are working in the business?
Well, that's a great conversation to have with your tax advisor, but the answer is highly dependent upon other circumstances. But if you did have two family members owning shares of that business, either directly or through a trust, and those shares were sold, yes, you could multiply either the QSBC lifetime capital gains exemption, or you could multiply. I'm not as sure about multiplying the entrepreneur's incentive, but definitely the QSBC incentive.
Right. Yeah. And that still works if the shares are held in a holding company?
No.
No. Okay.
No. To qualify for either of these, the seller of the shares has to be an individual. Now, that can be either an individual who owns the shares directly, they're the registered owner, or if they own the shares through a trust. So, but it has to be an individual. Yeah.
Okay.
Hi, this is Karina here. I heard like a lot of talks about like in trust and like a family trust, but I'm not really familiar with it. What's the benefit of like owning it through a family trust or an in trust? And I thought in a trust, like it has to be dissolved every 25 years, I think.
Well, so a trust, and here we're speaking of a formal trust. So we wouldn't be speaking of what's commonly known as an in-trust account. You may have seen those with financial institutions, which have accounts which they will call in-trust accounts. We're talking here of something slightly different, although the legal effects are similar. So we're talking about a formal trust here. Now, a formal trust is a legal entity which owns assets on behalf of or for the benefit of others, being the beneficiaries. We call those people the beneficiaries. Now, and the trust is managed by trustees. You can have as few as one, but you can have more than one. And the trustees are charged with managing the assets of the trust for the benefit of the beneficiaries. In other words, the trustees themselves, it's not for their own personal enrichment. They actually have a legal duty to the beneficiaries. That legal duty is specified by the terms of the trust agreement. There are many advantages for trusts, and I spoke about some of those in session number 2. But you get, trust provides some creditor protection for the beneficiaries because the assets are owned by the trust, and there are limits to creditors coming after the beneficiaries in terms of liabilities that relate to the assets of the trust. There's also a discretionary trust gives the trustees the power to split the income and allocate income to beneficiaries in a tax efficient manner. So, for example, if you're earning investment income, a trust is earning investment income. Instead of sending out $200,000 of investment income to one person, you could maybe, if you can split that into 5 people, 40,000 each. Well, depending upon their personal tax rates, that could potentially, I'm not saying it depends on the circumstances, but it could result in a lesser amount of tax, aggregate tax paid by everybody, and each individual personally. It also gives the, we've spoken here about multiplying the exemption. So that's, another advantage of using a trust. And there are many more in terms of estate planning, avoiding taxes on death, avoiding estate administration tax, formerly called probate tax, managing assets and wealth for when you've got minor children who are beneficiaries, and maybe you don't want to, dump $5 million into their checking account. It gives you lots of discretion to do that over time, right? And even beyond your own death. So the advantages are huge in terms of potential. In terms of the 20, you said 25. There is a 21-year deemed disposition rule. The trust doesn't actually dissolve at 21 years. What happens at 21 years, absent of planning, there is planning that can be done to avoid this, but absent of any planning at the 21-year anniversary, the trust will be deemed to have sold all of its assets and will be taxed on that deemed disposition. That's not an actual disposition. The trust does not actually have to sell all of its assets. It just means on its tax return, it has to declare all of its assets, and it has to declare the unrealized gain in those assets as income and pay tax on that income. So again, there is planning that can be done to mitigate that, perhaps even avoid it entirely. But that's what happens at 21 years. The trust does not dissolve. Yeah. Does that answer your question?
Yes, thank you.
Awesome. Thank you. Thank you both very much.
Shawn. Laura, you're muted.
Oh. Thank you, gentlemen, both very much, both Peter and Shawn, for joining us. As always, this is extremely fascinating, extremely interesting, and very, very informative. So thank you again for joining us. The information for both Shawn and Peter will be available to everyone. So if you require it, please don't hesitate to let us know, and we will have the slide deck made available as well. So if there's no further questions, thank you and have a wonderful day, everybody.
Thank you, Laurie.
Thank you, Shawn.
Thank you.
Yeah, thank you very much. Very
Thank you very much.
Pleasure.
Yeah, bye.
Bye.
My pleasure. Take care.